They say good things come to those that wait. And man, we had to wait this morning for the OPEC announcement to come out. We also got some really interesting surprises from the monthly numbers that came out on Friday. So let's make sure you're all caught up on everything. Hey, I'm Aaron with the Oil Balance with 30 years of oil trading experience, and I'm here to elevate your understanding of the oil markets. So let's break it down. All right, let's start off with the typical PowerPoint that we're used to here. But this week, I want to start out just jumping right into it and talk about what OPEC did this morning, the surprise that they came out with. Just to put this in context real quick, when they came out with these surprise announcements that they were increasing production back in April, March and April at those meetings, those results would come out on Saturday, a day ahead of when the meeting was scheduled. More recently, say the last couple of months, the meetings, that would be on Sundays, and then they'd have some sort of announcement that would come out early in the morning, at least Texas time, so that by the time I get up in the morning here in Texas, there'd be some sort of result, some sort of answer to what OPEC's going to do. But today they made us wait, and it was pretty interesting because there were some headlines out earlier in the morning about the time you would expect a normal announcement from the group. And the headline said something about they've agreed in principle to 137,000 barrel per day increase, but there's more to talk about. And you're thinking, so what more is there to talk about? So when the announcement finally came out today, it was a little bit surprising because we had been penciling in just a straight 137,000 barrel per day increase across, this is based on the wording that they had previously given us, but 137,000 barrel per day increase all the way through to August 26th, just month after month. And then they would be done with that 1.65 million barrel cut that they took in the market. That would all be replaced by then. But I think they did the really smart thing. They came out and they said, look, for Q1, demand is usually pretty soft. There's the turnaround schedule, the global refining turnaround schedule is already looking pretty big for Q1. Let's just wait. So they announced that they are going to increase production in December, 137,000 barrels per day over what they had discussed previously for November. But then Q1 should stay the same in terms of no increases. Now they went on in their news release that they put out and they gave two sentences, sort of those sentence paragraph deals, where they talked about the compensation plan and how that should become more evident now and how that should, maybe come to the forefront of the conversation a little bit more. And I think that could be a really good thing or a really bad thing for OPEC. The really good thing is you can maybe tell on this chart right here that for the month of October, the preliminary data we have from Petrologistics, so I want to again reiterate this is preliminary data. It's got to get revised as information comes in. But here at the end of the month, it's fairly solid that Petrologistics saw production in the month of October actually down slightly versus September, about 46,000 barrels per day. Now, if you go back and look at the announced increases for the month of October with the compensation plan, that should have been net down 66,000 barrels per day. So they actually did really well. If these preliminary numbers are fairly accurate, which I think they are, they actually did really well on sort of pulling things back. Now, the export front maybe is a different thing. Exports actually increased, but in terms of actual production, which is what the group grades themselves on, they did really well. So now it's going to be up to them, especially Iraq and Kazakhstan, to see if they can really rein in production through this Q1 time period. If they can, that adds a lot of weight to the group. That adds a lot of meaning when they come out and speak and they say they're going to do this and that. If they can actually control that production and maybe bring it down. So I went ahead and made a table for you here. So this is sort of the net of the December increases minus the compensation cuts. And then as we mentioned, there won't be any increases for Q1, just the compensation cuts themselves. So you can see we sort of hit a high water mark here in December, and then production should, according to plan, start to taper off as we go through Q1. And you can see it here too. on this chart, you get this little bounce back, and then by Q2, things should be bouncing up pretty well. Now that kind of assumes that it kind of assumes that they can jump right back to growing production in Q2. I think directionally that's the right thing to do. You probably do want to take a pause in Q1. And then as the market starts to focus on driving season or the bulk of demand season, at least in the Northern Hemisphere, then that's when they're going to start providing barrels back to the market. So I still have it in my model as 137,000 barrels per day. It's just we're skipping Q1 and now we're going from Q2 all the way to the end of Q4 26 with these increases. The compensation plan should cut off around September or so if they can stick to it. Again, it's sort of a big if, especially in Kazakhstan's part, because it really starts to add up as we go through the balance of the summer. But that would put them in actually a really good place in terms of credibility in the overall market, as to how they see the market and how they're, what they say is what they do, sort of thing. So that would be really good. If they're unable to control this production, we'll see what happens. It's like I said, it's really up to Kazakhstan and Iraq at this point. That puts Iraq in a bit of a tough spot, right? Because they just opened up the flows from the north. They just got the Kurdistan barrels flowing again out to Jehan. So that's going to be a little bit tough for Iraq to pull off. If they did cut production, you would hope it would be from the south and not the north, but who knows how they're going to handle that. But anyway, that's the big surprise coming out today. I think it's the right thing to do in terms of overall global demand. Like I said, the refinery maintenance program looks already pretty big for Q1, and we haven't even run into the unplanned outages, obviously, yet for that. But so let's move on here. As far as the market, it really felt like we took a break this week. We were down a little bit off this big rally last week. You can sort of see here on the red, my picture is covering it a little bit. This red bar is the volume for this week, and last week's volume was really quite high. We were nowhere close to replicating last week's volume. Just so many things went through. I think we stopped a lot of positions out last week, and that was really more the volume. So that's sort of good and bad because, you stop people out. In theory, there's more, bullets, or there's more money able to come back into this market, generally speaking, given that it's the very beginning of November. And a lot of, especially I'm thinking more on the hedge fund side of things, a lot of the hedge funds are usually their, calendar year end is also fiscal year end. So maybe they're not willing to really dip their toes back into this market if they got burned, if they got stopped out last week, thinking the market was going to completely tumble. I don't know if they're going to rush back in with only 2 months left in the year to try to, reinvest and make some money towards the end of the year. In the oil markets, they might choose to go somewhere else. So that maybe makes it a little bit tough. I still think we grind higher from here. As I mentioned, we're coming out of our turnaround season for the fall. And we have a couple months where demand should be pretty good for both gasoline and diesel here going forward. We are having cold weather right now in a lot of the country. And so that should spur some heating demand. And I'll show you some charts here in a minute that the market's, is definitely seeming to be reacting to that on the heating oil side. But just wanted to point out to you that the market definitely felt like it took a breather here. I would think it's going to be interesting to see what the market says about this OPEC cut. One thing you could probably think I would think it's bullish. I think most people, the way they had previously worded their news, their press releases, that they were going to just keep production rising across all of Q1, and that's always a little bit dangerous to do. So I could see how that could be seen as bullish. On the flip side, people might be reading that as bearish, that the market's not strong enough or secure enough to take those barrels, which it's not, but that shouldn't be a surprise, right? Every Q1, you get a big turnaround program. Sometimes it bleeds into Q2. It seems like this year it's probably mostly done by March, at least in North America anyway. So it'll be interesting to see how the market reacts to that. Overall, I'm still thinking fairly bullish, maybe back to this, more neutral ground here of the in between the two Bollinger Bands. and maybe eventually making its way up towards $70 mark by the end of the year if we have good demand going into the end of the year. So again, weather doesn't seem to be cooperating right now in terms of heating demand, but sometimes you can translate that fair weather in the U.S. for good gasoline demand going into the end of the year, especially into the holidays. If weather's nice, people might choose to drive to go see family or whatever for the holidays. So that brings us to the monthly production number. So we did set another new high in crude oil production this month for the month of August. That's the most recent date we have on the monthly numbers. Again, the monthly numbers are more robust than the weekly. The DOE spend a lot more time tracing everything and making sure the numbers are correct. So given the chance, you'd probably rather look at the monthly data. The problem is the most recent data point now is for August as of Friday, which maybe doesn't help you a whole lot in the beginning of November. That being said, we do, especially from an analyst standpoint, we do look at this stuff all the time. One thing I wanted to point out, I'm not sure that I had done this before, but when you look at crude production plus NGL production, we're actually at now a surplus this year to total demand. So it's not, don't think of it as exactly 1-to-1 because you're mixing and matching your actual sources of demand, if that makes sense. Like we have a lot more gasoline demand than of anything else than we produce. So we still need to be importing gasoline, especially on the East Coast and that sort of thing. So it's not exactly 1-for-1, but it is getting interesting that this is the first time in a long time, meaning going back to, World War II type time periods where our domestic supply, so in this case, crude oil plus the NGLs, is exceeding our total liquids demand, which is what this chart here is meant to show. So that's interesting. Of course, we're exporting a ton of stuff as well. Inventories still remain quite low, and I'll show you that here in a minute too. But just be aware that even in this lower price environment that we're in, we're still able to see production grow. What's going to happen for the balance of the year? It will probably slow down given the lower prices we've seen lately. I think we're still keying off of the price spike that we got back in June with Israel and Iran. On the demand side of things, demand did not look too good for August, especially if these are just the transportation fuels. When you break it down into gasoline and diesel demand, especially quarter by quarter, the gasoline is getting worse and worse as the year goes on. So a couple things about that. One, it might be, if you think about it, according to the government stats, you've got about 2 million plus people who have either been deported or left the country since the beginning of the year. I mean, that's like Jacksonville, Florida. That's like Oklahoma City, Missouri. Those cities just kind of disappearing as far as gasoline demand goes. So that's kind of a big deal. That's a bit of a headwind on gasoline demand. Diesel demand was also down year on year, which I'm a little bit concerned about. But again, it's August, so it's not a crazy problem right now. The September, October, November, December numbers have become much more important on the diesel side, especially because that's when you start getting into harvest demand and that sort of thing for the farmers, and then you start right after that you get into heating demand, which I mentioned. It looks like we are having some cold weather right now at the beginning of November. After that, it actually looks fairly warm for the East Coast, where most of that heating oil demand would be. That being said, demand is still, I think, sufficiently strong to keep inventories low, especially with this. We're currently kind of at the tail end of the, maybe 2 more weeks or so for the refinery maintenance season for the fall. And then we've got like a 6-week period from mid-November to the end of December to replenish inventories. And again, based on what the weather does, that'll be a huge driver. If it's super cold, which it doesn't look likely, that will continue to be a big driver on the diesel side of things on distillates. If it's really mild, which looks more likely right now, Again, gasoline usually tends to perform a bit better in those times of year, and that's really what we need from gasoline, given the numbers we've seen to date, is for that to sort of pick up at least on a year-on-year basis. Here's the inventories that the NYMEX contracts are based on: gasoline and diesel, still very low. This is Pad 1B, New York Harbor. Crude oil at Cushing, we did get an increase this week, but we're still at the bottom of the 5-year range. Propane looks a bit ridiculous. So we've got a ton of NGLs in the U.S. right now. So we set new all-time highs, 5-year highs definitely, for propane inventories here in the Gulf Coast. And then here's the RIN adjusted margins that we're seeing. So gasoline coming off seasonally. We talked about that last week. You can add a lot of butane into the gasoline mix and make things a lot cheaper. So this makes sense. Jet is taking off, if you pardon the pun. Jet prices have been really strong in the Gulf Coast, and now we're seeing a bit of an increase in the Gulf Coast diesel margins as well, sort of back to the highs we saw back here in late July, early August. But there's been some refining issues. Pad 2 has been really strong, like with the BP issues going on. So it's actually interesting. It's not really Chicago that's reacted as much as the group, so Oklahoma City and Tulsa. Those two seem to be reacting much more. Again, that could be part of harvest demand also, as harvest starts, going on now. So it's quite interesting. We're getting these strong diesel demand numbers, but again, that or the diesel crack margins here, which again just has me sort of looking at the various refiners. So again, I'm not really a stocks guy. I'm more of a commodities type person, but just kind of glancing at the Phillips 66 stock, tickers. Maybe that's a good place to park your money. You definitely want to do more research on that. But it looks like last year in Q4 they had a pretty good run. I think they're set up to do that again, just based on what I can see from the turnaround schedules and stuff like this going on. So just something for you to think about there on that front. So here's our recap. Again, OPEC surprised the market. I think it's going to be taken as somewhat bullish because there's less supply coming out in Q1. Market seems to be taking a minute. I think a lot of people got stopped out from the hedge fund side of things. I'm not sure they're going to rush back in and reinvest that money with only 8 weeks left towards the end of the year. And you got to take the holiday weeks out of that anyway, right? So that's going to be tough. So I think the market will just sort of steadily grind higher towards the end of the year, especially as we price in the lower inventories. The summer demand, again, not looking fantastic. A little worried about that gasoline number. I think I have, like I mentioned, a reason for that, but something to definitely keep a close eye on. Still, though, with low inventories and going in, with this change of season, with the cold weather coming in, I do think refining margins can perform. And with the big Q1 plans that we can see already, and again, that doesn't include the outages yet, but you've got close to 1 million barrels per day out in the U.S. from January to March. So that's a pretty big stretch of time to have refinery maintenance going on. And of course, that doesn't include any of the unknowns that it's bound to happen. That happens every year, right? Where just something goes offline unexpectedly. So again, that might be a good way to play the market in the short term, meaning the next several months. Maybe grind higher on WTI flat price, or ride a bit of a wave on the refining margins, depending on what your appetite is here in the market. So that's what I've got for you here. This week is probably going to be a much more interesting week, I would imagine, in the market this week with some of this data out and with this OPEC change. They changed it up a little bit. So good luck everyone out there. We'll talk to you later. Bye.